times where, you don't want to do it. So don't ever think that it's all, roses and things like that. Like, you have to have a mindset that is very disciplined and you're ready to grind, and that you take on that challenge. And, whenever I feel like, the world's closing in, or you have so much stress or pressure, you got to tell yourself, I signed up for this, right? And I wouldn't want it any other way. I wouldn't want to have I don't like vacation. I don't like going on vacation. I can't relax.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. And I'm your host, Hannes Henschel. Welcome to another episode of The Path to Wealth. I'm your host, Hannes Henschel. Today we have Zach Haptonstall, the founder and CEO of Rise Equity. Rise48, actually. To give you a brief background about our guest today, Zach, he co-founded Rise48 in 2019, which completed over 1.8 billion in total transactions and purchased 40 assets, over 7,000 units since 2019. He also founded Rise48 Communities, which allows Rise to be vertically integrated. To say the least, he came a long way since his first deal with Silver Oaks Apartments in Phoenix. Remember those 36 units, Zach, back then?
I do. Yeah, it has been a while.
Man, this is when I look at your timeline, and I'm sure this is not the first time you hear that. What you achieved in this 5 years is a tremendous accomplishment. And what are some of the key lessons that you took away from going from 36 units back then to now over 7,000 units in an multiple market portfolio spreading all over the US?
Yeah, and first of all, thanks so much for having me on your show, Hannes. Really appreciate it. Excited to be here. Excited to provide some value to the listeners. And it's funny, like when people say it's been 5 years, honestly, it feels like it's been like 10 plus years to us, because we went through. A lot of people don't see that the first couple years, we made no money. It was hard to get traction. It was really a grind. And then we kind of hit this exponential growth point where we kind of understood everything, and we could rinse and repeat and just keep scaling. And so it's funny, if you were to break down the first half of those 5 years to the second half of the 5 years, they're radically different, just as far as what we've done. You see the results on the second half, but the first half is where a lot of that initial learning and work and development was done. And so I think you could say that for anything in life, really, any business. But yeah, no, I mean, we've been really fortunate, and I think that it was a combination, Hannes, of probably around middle to end of year 3, all these things that you have to scale one of these types of businesses started to all hit at the same time, meaning that we started to gain a full control and understanding of how to renovate these units and have construction management infrastructure. We started selling deals and going full cycle so that we could prove to investors that we had track record. And when you sell deals, you attract more equity, okay? And you can 1031 exchange the equity that you have. We started sourcing off-market deal flow. And so all these things started hitting at the same time, where it's, okay, we're getting the deals, we have the equity demand, we're starting to generate revenue. We take all of our revenue and we reinvest into the company to cover overhead and to continue to build out operational infrastructure. Then you build the property management company. Then you bring the supply chain in-house. And so we've just always been trying to think, long-term and really reinvesting in the company. And so it's just been a combination of things that all started to hit. But it did take a while, even though I know on the outside it doesn't really seem like it.
You did say 5 years felt like 10. Do you feel like you definitely put in the workload for maybe an average person in 10 years?
Oh, I think so. Yeah, I think so. I think you could say we probably worked twice as hard. Because a lot of people say, well, hey, how'd you guys do it? And again, we say this with all humility. I'm not trying to sound arrogant or cocky, but we don't have data to support this. I just think that I can't think of anybody who's working harder than us and who wants it more than us. Like my partner Bikram and I, we're here every day at the office, 9 a.m. to 8 or 9 p.m. every single day. Like on Fridays, we might leave at like 7 or 7:30, and then I go home and I'm doing emails and I'm working on the weekends. And, I'm not doing it because I'm doing this grind that I don't like. I'm doing it because I love it, and this is my life. You know what I mean? So like, this is what we do, and we want to be the best. And I think a lot of people whether it's in this business or any business, but specifically in this business, you buy a few deals, you start to feel success, and then you get complacent and you kind of fall off, or you get what I call, soft, mentally soft, emotionally soft. And for us, we have goals that are so big that we honestly don't feel like we've achieved anything yet, and we have a lot to prove. And honestly, I think that we kind of have a chip on our shoulder, so to speak, where we have a lot to prove. Because when you grow in a short amount of time, you get a lot of praise, but you also get a lot of people that doubt you and say, hey, well, you've been lucky. The market was strong. You guys are going to crash and burn. You're going to tank. You haven't been through a downturn. So now we're in, at the time of this recording, Hannes, here in end of March of 2023, interest rates have skyrocketed. We're going into an economic downturn. And we're actually excited, and we see this as a big challenge because we want to prove to everybody that we will get through a downturn, and we're not just this pop-up company that just disappears. We want to be here for decades to come, and so we see it as a challenge. We feel like this is a way to separate ourselves from our competition and show investors that in the good times we had better returns than anybody, and in the bad times we protected your capital and we still had better returns than anybody. And so that's the kind of the way we see this. So I think it's just a lot of it's the mentality and what are your goals, because if you don't have the goals, then it's not going to give you the fuel to drive you towards what you're trying to achieve. And so I think that's what a lot of it is made up of. It
sounds like they say if you find something that you love, you will never work another day in your life. Is that how it feels to you?
Yeah, it's like a cliche, right? Like people hear that and they're like, okay, that sounds like BS, but it's true, because when you work for yourself, you don't have a boss. There's ultimate accountability, right? I don't have anybody who's going to tell me, hey, you're not doing a good job today. I have to look at myself every night and be like, okay, did I give it everything I have? And on the weekends, I spend a lot of time just, working out and stretching and just reflecting and quiet about the week I had and the upcoming week. And that's like the ultimate, accountability test. It's like, what did you do this week? What do you need to do? What are you going to do this weekend to get your mind ready and your emotions ready to take on the storm of challenges and stress that you're going to face the upcoming week? Because every week there's pressures, there's stresses, there's different things, whether it's dealing with operational staff, whether it's the pressure to raise millions of dollars so that you don't lose your earnest money, whether it's public speaking events, whatever it is. And so, yeah, I think that, you don't view it as work, but it is a grind, right? I mean, there's times where, you don't want to do it. So don't ever think that it's all, roses and things like that. Like, you have to have a mindset that is very disciplined and you're ready to grind, and that you take on that challenge. And, whenever I feel like, the world's closing in, or you have so much stress or pressure, you got to tell yourself, I signed up for this, right? And I wouldn't want it any other way. I wouldn't want to have I don't like vacation. I don't like going on vacation. I can't relax. I don't like to relax. So this is what I signed up for. The challenge is the fun part of it, because when you overcome it, it just makes it that much more worth it, right? And so I think it depends for everybody, right? And it's not, and I think it's a unique type of person too. Like, I think that when people say, oh, if you love what you do, you don't work a day in your life. Well, I don't think that that's most people. I think most people, and it's not a fault, right? Some people might think I'm crazy, or like, there's something wrong with me, which is fine. I'm just different than most people. But a lot of people, it's healthy for them to have a balance of work and relaxation, things like that. And that's fine, because they're not going to measure their life on what they do with their work. But for us, it's not about making money. It's really about overcoming the challenge, and it's becoming, it's about being competitive and being the greatest to do what we do. It's about being the best at what you do, and that's the fun part of it. And so anyways, yeah, I think that, there is a lot of truth to that, Hannes. It's not just a cliche, where there's more to it than just feeling like you're working.
Yeah. So this week, I already had the pleasure to speak with Michael Becker, and I got his insights on where the market is going. And nice. We also spoke to Charlie Young, and I get his insights on where the market is going. So since you want to play with the best, I would really like to hear what you have to say. Where are we in the cycle? Where do you see this going, and how do you protect your investors?
Yeah, no, I know Mike Becker. He's a good guy, smart guy, very successful. I was actually hanging out with him for a bit at the NMHC conference a month ago in Vegas. And so good guys to talk to. And yeah, so basically, kind of where we're at now, Hannes, and then I'll kind of go into where I think we're going. So, it's March 2023. We're 12 months into the Fed doing these, historically aggressive interest rate hikes. It's been well over 450 basis points they've hiked rates the last 12 months, which is the most aggressive since the 1980s. And so, inflation continues to remain high. The only thing they have to combat inflation is to raise these interest rates. And so right now, values of these apartment buildings are down at least 15 to 25% from where they were in Q1 of last year. In the short term, values are all down because interest rates go up. The debt is more expensive. Buyers have less purchasing power, right? And so the way that we see the market right now is that all of our investments are always 5-year conservative projections for the investors, right? So we say, hey, we're going to buy a deal, and there's a stress test in our underwriting models ever since day one. And it says that we're going to buy a deal. There will immediately be a recession where organic rent growth plummets, vacancy goes up. We hold through the recession, we execute the plan by renovating 100% of the units, and we sell in year 5 to achieve the returns we're projecting to investors. Since we've started, we've purchased 40 deals, about $1.6 billion. We've sold 11 of those, gone full cycle, sold 11. They were all home runs for investors. We're averaging to sell those deals in like 18 months. And that's because the market was really strong, right? And a strong market can make anybody look smart, right? And we've been benefactors of that too, no doubt, right? But we've also been able to build out infrastructure and demonstrate the ability to renovate these units on schedule, on budget, and truly push NOI. And so we're now putting our quote unquote stress test to the test, because I've been telling investors the last 9 months now, after, like last summer, after it was very evident the Fed was not going to ease up on these hikes, I said, hey, I'm not going to double your money in 18 or 24 months anymore. It's just not realistic. It's always been a 5-year projection. And when we could double your money in a short amount of time, that's great. We'll take it while we can. But it's always a 5-year projection. So this is going to take truly 3 to 5 years to hit these projected returns. Because when your interest rates are higher, your debt is more expensive. There's two things: higher interest rates and organic rent growth has been decelerating and normalizing across the country really since last summer. For those two reasons, it takes a little bit longer to hit that target exit valuation of the property in order to hit the target returns for investors, right? And so, my thoughts are that, I think the next Fed meeting is in May. I just saw an article this morning that there's like a 50-50 chance that they might do a 25 basis point increase. Just in the last few weeks, there was kind of a wrench thrown into everything with these banks collapsing, right? Nobody really saw that coming. And I think that was kind of like a red flag to the Fed that they may need to slow this down. So, I hope that everybody's been saying, since, Q4 of last year, that they think the Fed will stop increasing rates in the summertime of this year. It'll kind of plateau, and that a lot of people don't think the rates will start to come down until next year. Okay, I agree with that. I think these banks collapsing could change that, potentially speed up rate cuts, but they're going to want to see inflation going down. So my thoughts are that, if and when the Fed stops increasing rates, a lot of these lenders are going to start to cut their spread. Okay, the interest rate is made up of two things. It's made up of the spread, which is the lender's fixed profit margin, which floats over the index, which is the SOFR for most of these loans. Well, those two combined, you add those up as your all-in interest rate. Well, lenders have been on the sidelines, just like private equity groups, since last summer for the most part, and they have pent-up capital they need to deploy. So once there's certainty that the Fed will stop with these aggressive rates, and we've already started to see this happen, by the way, Hannes, but these lenders will start to cut their spread so they can lower the all-in interest rate to incentivize borrowers to borrow so they can start deploying capital, okay? And once you see interest rates stop hiking, or there's at least certainty we've hit the ceiling, a lot of these private equity groups, a lot of our competition are publicly traded REITs, and they're paying out dividends to investors. They have to deploy capital to generate a yield, okay? And so kind of like during COVID, I'm not saying this is directly comparable to COVID, but kind of like COVID, you have all this pent-up demand where people were on the sidelines. I think in the second half of this year, if interest rates stop going up, even if they don't go down, a lot of this private equity is going to start flooding back into the market, and it's going to create competition. I think it will slightly decrease cap rates because of competition. I don't think it'll be significant. I personally do not think there will be a lot of distress in the multifamily market. And it's because most owners of multifamily is like a joint venture between a sponsor and some institutional private equity group. I've spoken a few panels. I was on a panel with Blackstone in January at a private equity conference. And all these guys are telling me like, yeah, we're doing capital calls on our deals, but we're just infusing more money with our private equity partner because they understand real estate, they're well capitalized. We're already starting to see some distress with syndicators, okay? Syndicators who have retail investors that their interest rate cap is expiring or they're negatively cash flowing, they need an infusion of capital. If they go call for capital from their investors, those retail investors don't understand. They're not going to be happy, right? So a lot of them are saying, I'm not going to infuse money. Those deals, like we just bought one last month. We have another one coming up in Dallas. It's distressed. We're getting at a low basis because it's a syndicator. They need to get out of the deal. It's a fire sale. So there will be some of those, but I think that, let's just say the Fed starts to cut rates in Q1, right? Q1 of next year. Once interest rates start to come down, cap rates will compress and values will go up very quickly, okay? And so like the longest deal that we've owned that we have right now, we bought it in June of 2021, okay? So it'll be about 2 years this summer, and we feel really confident that all the deals we bought, even in the last 2 years, we're gonna hit or exceed our returns in 5 years or less, because we're still having no issues renovating units on schedule, on budget, and hitting and exceeding our pro forma rent, okay? So even though debt service shot up, we're still increasing NOI. So as you know, Hannes, I mean, the biggest, you can talk about all the underwriting assumptions you want. If you want to talk about the two biggest factors to valuations of real estate, commercial real estate with multifamily, it's where are interest rates, where's your NOI? So we're just focused on controlling what we can control, which is maximize NOI by renovating units, right? We have interest rate caps right now to protect us. We have 3-year caps on every deal. We have plenty of cash reserves at the property level, so we have a lot of liquidity. And once these interest rates come down, cap rates will come down as well, and values will go up, and we feel like we can start to sell or refi these deals. And so my thoughts are that, you're in for a rocky period this year. I think you have a Democratic administration that's coming up for re-election next year. They're going to want the economy to look good, heading into November. And so I think that's beneficial to potentially cutting rates. So anyway, I think that we're still bullish on multifamily. It's just you have to be conservative. You have to mitigate against interest rate risk right now, longer hold periods than we've seen the last 5 to 7 years.
I mean, it sounds like you already positioned yourself fairly well. You said you're well capitalized on the property level. So, you either saw that coming, or I'm not sure, did you have to do any capital calls?
No. Yeah, good question. So we've never done a capital call in the history of our company. And we actually did a webinar about 4 or 5 weeks ago to all of our investors. We did a live webinar and we blasted this recording out to over 5,000 people. Basically, so we've never done a capital call. We don't plan to do any capital calls on any asset in all of 2023 or 2024. And the reasons for that, Hannes, and we went over this in the webinar, is that we've always taken lower leverage, 60 to 70% loan to value. We have a few deals that we took the highest leverage we ever took was 75% loan to value. This is when you could get 80, 85% loan to value, right? We've always been lower leverage, 60 to 70. We've purchased 3-year interest rate caps on every single deal we've ever bought. Okay, regardless, even when interest rates were low, we just always bought a 3-year cap to be conservative. And then one thing that we're kind of unique in the doing is that we've always raised significant cash reserves on the front end of every deal, which are completely separate and not allocated to anything. Okay, this is separate from like CapEx, separate from interest reserve. It's just rainy day cash at the property level. And a few years ago, some investors would criticize us. They would say, hey, I don't like how you're raising all this cash, you're diluting the returns. And we would just say, okay, well, that's how we underwrite, don't invest with us. And now, that's actually why we're in a good position, because a lot of our competition, many syndicators across the country are doing capital calls right now. And we know that because our investors tell us, and sponsors who I'm friends with are telling me, yeah, I have to do capital calls. And it's because their debt service shot up. They don't have cash reserves to cover that delta in the short term. And then a lot of them are doing capital calls because they have interest rate caps that are expiring this year and they only bought a 1 or 2 year cap, right? So they need to infuse capital to buy a new cap. For us, like I said, our first interest rate cap doesn't expire until the first one will be June of 2024. Okay, so we have a full financial planning and analysis department on our team with analysts. We have over 200 plus full-time W-2 employees at Rise48, but we have an FP&A department. Every single month since last summer of 2022, we have them doing a full stress test analysis on every deal, which assumes the max interest rate at every property for the next 36 months. It significantly shaves down NOI growth assumptions. And the whole goal is to see, do we run out of cash at that property? And we don't run out of cash on any property. We don't have to do a capital call. And then we have them saying, okay, what is the minimum NOI we need to get to if we renovate all the units and interest rates don't come down so we can qualify for a new loan, like a 10-year Freddie Mac loan to pay off the bridge loan. We'll use those loan proceeds to buy a new 3-year interest rate cap. Okay, even if we don't return capital to investors, we protect that downside. We have a new 3-year cap. And then, we've renovated everything. We can just focus on operations. Once interest rates come down, we can sell and get a good valuation. So that's kind of how we're positioning everything, is that we've drastically increased the velocity of renovations across the portfolio this year. Okay, so last year, Hannes, we were doing 50 to 100 units a month. And to give you an idea, like on context, we're the number one buyer of apartments in Arizona over the last year, and we're like the number 3 buyer the last 5 years. So we just passed like Blackstone, right there next to Goldman Sachs, life insurance companies. We have 5,500 units under management right now in Phoenix. We also have a couple deals in Dallas. And so we were renovating 50 to 100 units a month last year, and we weren't going full speed. We were intentionally going slow, leaving meat on the bone. Well, we realized, okay, we need to ramp this up. So once holidays passed, we built out, our infrastructure even more. We're doing between 200 to 250 units a month right now. We just did 240 last month. We're doing another 200 units this month in March. We're cranking through these renovations because we're still hitting and exceeding our pro forma rents, increasing NOI. And the whole plan is maximize NOI. So even if we get close to that interest rate cap coming, we have enough NOI to qualify for a new loan, pay off the first loan, get a new 3-year cap, right? So that's kind of how we're positioning the portfolio. So we feel insulated, and we're still seeing a lot of leasing demand for these renovated product, and we feel insulated because our average rent across these 5,500 units is about $1,200 to $1,300 a month. Okay, so very affordable. Class A tenants are trickling down. People cannot afford to buy homes, and it's pushing people into this Class B space. So that's kind of what we're seeing.
Yeah, and I've been on a call with you last year, and you were explaining to us how you're basically getting into supply chain and allowing yourself to be in the position to build all of this. And I think this vertical integration is what allows you to first build on budget, and secondly, build on such a amplified time horizon, because, many of the regular syndicators that don't have that level of infrastructure, they're definitely struggling with turning around units and keeping costs in check. And I think this is something that really sets you apart already.
Yeah, no, it's a great point, Hannes. And yeah, you're familiar with our structure from our call last year. And so, yeah, I mean, and we've, we're grateful that we built that out when we did, right? Because at the time of us building it out, we didn't necessarily need to. And now I think a lot of sponsors, they need to do that. And it's almost too late because it's very difficult now with the cost, where the cost of things have gone. And so, a few years ago, we first took construction management in-house, where, our staff was sourcing, bidding out, and managing on-site labor, right? So we were still using third-party property management, but we were doing construction management in-house, which is really the most critical thing. If you're going to, in my opinion, you should take construction management in-house before property management, okay? So that was important. Then we took property management in-house. And so all of the on-site maintenance, leasing, managers is all of our staff. So we have full control over payroll, leasing incentives. We can incentivize our on-site staff to truly meet the goals of that property for that month, right? And we pay people very well, and we have the most competitive benefits in our market. We cover 100% of all of our employees' medical, dental, vision, 50% of all their dependents. And so that allows us to recruit and retain the best people, so we have continuity and we have less turnover, which is critical for property management. And then, as you mentioned, Hannes, we also started to control our supply chain. So we started buying all of our materials for the interior renovations directly wholesale from an overseas manufacturer. Okay, so we do a very high-end scope compared to most of our competition that's doing 80s value add. We do quartz countertops, stainless steel appliances, brand new cabinet boxes. So we basically take the unit down to the stud. We strip the entire thing down, and it's like a brand new unit in there. Okay, and because we're buying everything wholesale directly overseas, and we're buying hundreds of units in advance, we have truly fixed pricing. We have not had any issues for any inflation or supply chain issues in all of 2021 or 2022. Okay, and that's because we renovated over 1,000 plus units the last 24 months. That's when we weren't even going full speed, and we're buying everything directly wholesale. It gets drop shipped into our units, and then our construction crews have to use our material. So yeah, it allows us to kind of create a blueprint, like an assembly line, that we can just stamp out unit after unit. We know our costs are fixed, our labor is fixed, and we can conservatively budget that in our model. Whereas, that same type, and to give you an idea, Hannes, that scope, all in for labor and materials, is about $15,000 to $16,500 per unit. Okay, like locked in. That's a conservative number with contingency built in. If we were to try to do what most people do. And what we used to do a few years ago is you have to go find these materials from like Home Depot, Lowe's. Even if you have like a commercial account with Home Depot, they oftentimes don't have everything. That same scope costs you $25,000 to $30,000 a unit. So we're paying almost half, of what we would. Right now, it costs us the same to do quartz countertops as Formica. It's the same for stainless steel as black appliances. It's actually cheaper for us to just strip out the cabinets, put in a new box with a new door, than try to repair the existing 1980s box and paint it and just do new doors like most people do. And we used to do that. So yeah, it gives us a lot of efficiencies. It gives us a lot of control. And so, we had all that established before this downturn, right? So now we feel like, we're in control of our entire operation. And now we've expanded to Dallas. We have the same exact platform in Dallas, right? Our supplier has 2 warehouses in the US. One is in Phoenix, one is in Dallas. That's a big reason why we went to Dallas, is because it's the exact same, strategy in that market.
Do you feel like you could have a bottleneck because you're working with one particular supplier?
Yeah, good question. We haven't had one yet, and we're their biggest client, and so we haven't had any issues. The owner is a friend of mine, and he also is one of our investors, and so they're manufacturing everything private label. And so in Phoenix, they have a 35,000 square foot warehouse. In Dallas, they have a 70,000 square foot warehouse, and it literally looks like a Home Depot. You go in there, there's racks all the way to the ceiling, 20, 30-foot ceilings, and they're just stacked with private label stuff that they themselves manufacture and distribute, right? And so everything is always the same in all of our units. And we've had other suppliers in the past that we can go to, but not at this scale. And so we feel like we have a lot of leverage and control because they're growing with us. You know what I mean?
Yeah.
And so we have all their attention. And if we need something customized, and they have other clients, but they don't have any clients as large as us. And so we're their biggest client. And so they're basically customizing their operation. Like, for example, they used to not drop the materials inside the unit because logistically it was too difficult. We told them, hey, we need you guys to drop it inside the unit. I mean, that's just what we need, okay? So they're dropping it inside the unit. So basically they're dropping 2 pallets inside every unit. Our guys go and unwrap it, and everything for that unit has been custom measured and assembled for that unit. So it has the exact amount of measurements of vinyl plank flooring. They're doing all the prefabricating of the quartz countertops on site at the unit. All of the cabinets have already been assembled on the pallet, so our guys just have to hang them. And so it makes everything, very, very customized and very efficient. And so, yeah, we haven't had any issues with that. I think the biggest thing is that as long as we give them a forecast, right? We give them like 90 to 120 day forecast of, hey, we need this many units. They can manufacture it, get it shipped over, and everything is working really smoothly. So that's kind of been our experience.
It's actually incredible just to listen to you, the level of efficiency. Like when I hear you, okay, this is already customized, this is already put together. And in every step of what you're describing, I see more and more cost efficiencies, time efficiencies. And I'm just like, I think this is really the formula of Rise48 that puts you aside, because you're going in so deeply into the system. And honestly, last year when I was on the call and I listened to you speaking about warehouses and building out all of that, and I was like, oh my God, is that a sensible move? But I mean, obviously now, a year later, it has proven to be the exact right strategy while others are struggling. And as you mentioned, average syndicator has twice the cost to do what you're doing, and it doesn't even look that good. Like it doesn't come out in the same quality. And if a similar tenant would walk in a unit, they will always choose yours.
Yeah, you're right. It's more competitive, right? It's like it's a higher level scope. And I mean, the biggest thing, Hannes, like firsthand, the last 5 to 7 years, we kind of touch base on this. Anybody could buy a quote unquote value add deal. They wouldn't do anything to it. The cap rates compress, organic rent growth goes up, they'd sell it, look like a genius. The truth is there's very few operators across the country that I know that can actually renovate units on schedule and on budget, and even fewer that can do it at scale. It's very difficult. Any of you who have ever, had like vendors or contractors work on your house for renovations know it's a pain in the butt to work with contractors. Well, imagine doing 100, 200 units a month, at scale. there's a lot of moving pieces. And so I think a lot of people look at us and they say, oh, these guys have grown so quickly, you know, the market's been strong, they're just like a transactional acquisitions company, and that's the outside perspective. But the reality is that the majority of our resources have been invested into operations staff. Okay, our asset management team and our operations team is by far the bulk of our payroll, you know, for our concentration, you know, of overhead. And so, you know, we've hired a ton of people. Like, we have, not only do we have an asset management team, we have 5 regional directors, we have a VP of ops. These are all 6-figure salaried employees, right? All of them have 100% benefits covered. We have a quality control department, okay, and we have construction coordinators. So we have different steps of people that are just focused, because when you're doing value add, this has always been the case, but it's now especially critical. When you're doing value add, you have to actually be able to execute a business plan, okay? You can't buy an 80s deal and, especially now, rely on organic rent growth. The organic rent growth is dead, okay? We're assuming 0% organic rent growth in year 1 right now for all of our deals in Dallas and in Phoenix. And so if you cannot renovate a unit on schedule, on budget, provide a higher quality product, and force appreciation, your investment will fail, right? That's just the reality. So we know how critical it is, and that's the bulk of our attention. You know, on Friday, I just spent 3.5 hours in an operations meeting, you know, with our regionals. We do that every 2 weeks. Every 2 weeks, we go through this with our staff. And I just spent another 2 hours yesterday meeting with our VP of Ops and Director of Asset Management, making sure that we're renovating things on schedule and on budget. You know, it's the most critical piece. And when you do that, then your properties perform. And we have very detailed, intricate investor reporting. So investors can see firsthand the results that we're getting. And then you start to have exits. Even if you're not exiting, if you can show that you're executing a plan the first 6 to 12 months, it gives investors transparency and confidence, so you can go raise more money and keep buying more deals. You know, a lot of people that think you get lucky, you don't get lucky and buy 40 deals, because if the first 5 don't go well, people don't invest with you again. You know what I mean? It's like you can't raise money. We're raising hundreds of millions of dollars. You know what I mean? So it's like, it's not that simple. So yeah, it has to start with operations. You know, that's the key, because that's what gets you the results to then, you know, attract, you know, more equity so you can find deals, things like that.
Let's talk a little bit. You mentioned staff retention, staff efficient, team building. Where did you first have the sense for going about team building this way? Because I'm very aligned with you. You know, I want to hire the best people. I want to retain them. I want to treat them well. I want to give them benefits. And ideally, they will die kind of working with me, you know, down the road at some point. That's how I look at it. I don't want to, I don't like friction of rehiring. I don't want to retrain people. So how do you go about team building, and really, where did that culture originally come from? Is that your DNA?
Yeah, that's a good question, Hannes. Yeah, and I think that, yeah, I don't believe that anybody's born with that, right? I think, like anything, you have to develop that, and it's through your experiences. And so, like, I wasn't born a business owner. I was born into a lower middle class family where my parents have always been, you know, 60 to 80K a year earners, and so I was taught to go to school, get a good job, be an employee. And so, you know, I think, you know, when we talk about team building, I think sports are a big part of it. You know, I played high school football, college football. You know, I was a captain on my team in high school. I understand, you know, the importance of camaraderie and different, and not to get cliche, but I think sports are important because you understand how to work with people. And then my biggest thing was, you know, I worked in healthcare sales for a hospice organization. And, you know, initially I was like a strong producer individually. And then I was promoted to director of marketing. Okay, and when you become a director and you're managing people, it's a totally different dimension you've entered, right? And because not only do you have to produce and bring value yourself, but you now have eyeballs on you at all times where they're looking to you, and you have to lead by example, you have to support them, but you also have to hold them accountable. And so it's a fine line, and you have to figure out, okay, who do I need on this team? Who am I missing? How can I make everybody gel? And so I think, you know, getting that management experience in my early 20s, because everybody I was managing was older than me. Okay, so it's weird when I was literally 23-year-old director of marketing, okay, making more money than people that were like in their 40s and 50s, and you have to gain their respect. First, I gained their respect by outproducing them, right, and by being humble, leading by example. So you start to learn, you know, the different intricacies. And then later on, I became the president and co-owner of a hospice organization, right, and I was 27, I was the president of a company. We had 50 employees. We scaled it to 110 employees in 18 months, and we sold it to a hedge fund. Okay, so that experience was invaluable. And by the way, that that was like while I was doing real estate, because I quit the job initially, lived off of savings, bought a few deals, had to go back to get a job because I was broke because all my money was in real estate. And so I did that I was doing both for 18 months and working full time as the president of this company. That gave me a lot of experience with understanding all the different dynamics, the politics, and how different departments need to interact. It showed me how to recruit, how to hire, how to train, how to delegate. And the biggest thing is creating autonomy, and trying to find, okay, what are these different departments? What is their role? Who's going to be the leader for this department? And then are they going to be able to manage the people below them? Everything will kind of fall in line, because there's no way I can manage 200 plus people. You know what I mean? It's overwhelming. And so you have to find good people. And when you find good people, people who are good know they're good, right? And it doesn't mean that they're cocky, but they know that they're a top performer, and that they know that, they're hardworking, and they want to be compensated at an elite level if they're producing elite results. And I knew that from being an employee, right? I knew that I'm a top producer. I want to be compensated top dollar. And I got to the point when I was a marketer where I felt like they weren't compensating me. And so I wanted to leave, right? It's kind of like a sports free agent, right? It's like, there's market value for certain positions. And if you don't pay me market value, I'm going to go get it from somewhere else. And so we kind of take that same mindset here at Rise 48, is that if you prove that you're performing, we will pay you top dollar in the market, because we want you to be happy, and we don't want to feel like we're taking advantage of you. But at the same time, if we're paying you top dollar, there's an expectation and a standard of excellence that you need to meet, right? And if you don't meet it, then you're going to be held accountable, and you probably won't last very long. That's just the reality, right? So there's a trade-off there, right? Like, we'll pay you very well. You'll get really good bonuses. We do a 20% annual bonus of the employee's salary for our entire corporate staff, paid out quarterly. So people can make a lot of money here. So our whole thing is like, we just said this at our last all staff meeting, right? And we said, I don't care what your resume says. I don't care what your experience is. If you can come in here and show that you're producing, you will get paid, and we will promote you. And we don't have to wait a year or 2 years like a corporate company. You could be here for 6 months, and if the results are evident, then you will get paid. You know what I mean? So that attracts hungry, ambitious, competitive people we also don't want egos, right? We want you to be humble and be a team player. So I think it all just depends on how do you structure your compensation, how do you structure incentives, and what is the philosophy, and be real with people. And when they do perform, you have to deliver as a business owner. You have to pay them, right? And do what you said you're going to do. So I think, we started to create that type of culture. And I think people see other people getting promoted quickly, and they see other people getting paid, and it encourages them and makes them competitive, right? Because they want to earn that. And if you're not somebody who wants to earn that, you're probably not performing very high anyways, and you're probably not going to last very long. It's just the reality. So it just creates this entire, culture of that.
And I think that really boils down the word culture. You basically have a culture of A players that are all hungry, that all see what's possible, and together they don't just double the effort, they're like 100x the effort.
Yeah, and they all hold each other accountable, right? It's like I don't need to worry about, initially when we were a smaller office, I felt like I needed to worry about people getting here on time. Like, because we don't allow remote working, okay? I know a lot of people like to do that. Everybody has to be in this office every day, and then we obviously have like property level staff and we have field staff, but if you're a corporate employee, you have to be at the office every day from 9 to 5. And then when we were smaller, I would worry about some people being late or not showing up. But as we've gotten bigger, not only do their managers and directors hold them accountable, but people hold each other accountable. You know what I mean? It's like if your colleague who's an equal to you is always here on time and you're showing up late, you feel like you look bad to that guy. And it's not even necessarily he's going to tell on you. It's just that you don't look like you're performing, right? And those people don't typically last as long. And so, yeah, I mean, culture is kind of a cliche buzzword, right? I mean, it's hard to define exactly what it is, but I think that if you have like a clear goal for where your company's trying to go, like we want to grow, we want to be the best, right? And so we want the best people, and we're not here to sugarcoat it, right? We're not going to be politically correct, we're not going to be rude, we're going to be respectful, obviously, but just tell people, hey, there's an opportunity here. If you work hard, you're going to make more money than anywhere else, and we want you to know that, and we'll deliver on our end if you deliver with the results. So I think all that stuff starts to feed into itself and it gains momentum. But at the same time, like property management, Hannes, it's a very high turnover industry, right? And so I feel like we have a lot less turnover in our corporate staff, and in property management, the industry standard is 30 to 40% annually. for like on-site staff, maintenance, leasing, on-site managers, and we're probably at that. And it's because we have corporate people who are our regional directors who are managing these people who understand the standard, right? And so if they're not doing what they need to do, then you're going to get replaced. It just is what it is. Or they'll start holding them accountable, and these people just naturally quit because they don't want to be held accountable. And so, it goes both ways. It's not always, super pretty. You have to be tough in the property management industry.
Yeah, but as you said, you have to be tough, and you have to hold them accountable, because otherwise it dilutes the culture of excellence.
It's exactly right. Yeah, you'll erode your standard. And people, like, leading by example is the biggest thing. Anybody can like tell somebody to do something, but if you see somebody who's your peer or your manager who you can tell is grinding, and busting their butt and working hard and getting results, it motivates you to meet their standard. But at the same time, if you see somebody coming in late, you can tell they're not working hard. It just tells you, oh, well, if that's okay, then I'm going to do that too. And it just doesn't push you. And then we're humans, right? It's like if you go to the gym and there's a bunch of people, you're probably going to just work out hard. There's people everywhere, looking at you, you feel like, as opposed to just working out by yourself. And so it's just human nature. I know in sports, people say like competition breeds success. And so you want to create a healthy, competitive environment where everybody is holding each other accountable, because you're trying to draw the best out of everybody. And we have to draw the best out of each other. But if you have, people who don't care or not working hard, it can actually bring down the group. And so you have to kind of always be aware of that.
Yeah, I love that. And it sounds like you really, listening to you, I feel like you're really finding the balance between all of the good components, like caring for them, being humble, compensating them well, and leading them right, but also seeking out the best and being tough with them when it's needed, and I think, just from our conversation, it sounds like you're really finding that line. So I want to really acknowledge you for that. It sounds like you're getting it right, and I think it's part of your success. On a different note, you recently opened up a office in Dallas. Again, you're bringing the culture to a new city. What made you choose Dallas besides that the storage facility you mentioned earlier, that you already had a partner infrastructure? What about Dallas in terms of the market dynamics do you appreciate?
Yeah, great question, Hannes. So we've had the equity demand now from investors for over 2 years to expand to a new market. And some of these people have invested in literally 10 or 15 of our deals, and they say, hey, we like investing with you. We like your reporting. We like you as an operator, but I don't want to have all this money in one market. Like, are you going to go to another market? And we've been telling people, yeah, we don't want to rush it. We want to make sure that all of our infrastructure and our back office and all of our systems are built out in Phoenix so that we can responsibly scale to another market. Because a big reason for our success in Phoenix is that we've intentionally stayed concentrated so that we have, economies of scale in this one direct area, right? And so we wanted to be able to do that. And, we just think, Dallas, regardless of the supplier, we think Dallas and Phoenix are the top 2 markets in the country for multifamily fundamentals: job growth, population growth, diversified job growth, right? And there's a lot of good markets, right? We want to be in the biggest markets in the country so that we feel like they're more insulated in a downturn because you have diversified employment. And then we feel like in a good time, you have this explosive rent growth. And I'll pay a higher price per door and a lower cap rate to be in a stronger market, okay? Because the location is so important. I don't want to be in any tertiary markets or anything like that. So we like Dallas because it's similar to Phoenix in the sense that it has strong job growth, population growth, diversified employment. Obviously, it has very high property taxes and high insurance, so you have to adjust your underwriting to account for that, whereas Arizona has very low property insurance, or low property taxes and insurance. And Arizona, Phoenix specifically, I should say, has had significantly explosive rent growth the last 3 to 4 years, and now it's started to decelerate and kind of flatline. Dallas has not had nearly as strong of rent growth, but it's been more steadily inclining. So we like Dallas because there's a lot of 1980s product that has not been turned over, and we feel like it's a 2-hour flight. So I'm there every couple weeks. I was just there last week. I'll be there soon again in another couple weeks. And so, so we basically opened up an office there, a 9,000 square foot office in downtown Dallas. This is all before we even had a deal, honestly. We wanted to have infrastructure. We opened up an office. My wife and I bought a second home in East Dallas so that we can, have a local presence and be there every couple weeks. We didn't move to Dallas. We're there for like 6 to 8 days a month, a few days every 2 weeks. Bikram and I are traveling there every couple weeks because we have a full leadership team there. We have about 20 plus full-time W-2 employees. So we hired a regional vice president, a regional property director, an asset manager. We transferred our construction manager from Phoenix to Dallas because he wanted to do that. We have an office manager, HR, IT coordinator, marketing coordinator. And so we made sure we hired all these people and had infrastructure before we even had a deal in place, because we wanted to, make sure that once the deals start to come, we can execute. And so that's why we like Dallas, is just because it's very similar.
Nice. Well, Zach, this has been beyond inspiring. Just listening to you, you're kind of on a different dimension of things. One of my favorite questions towards the end, what do you consider a life well lived?
Yeah, I mean, I think a life well lived for me is I used to work in hospice, right? So I would literally meet with people who were about to die all the time, every day. And I would meet somebody and they would die the next day, or they would die the following week. And so a lot of these people and their families, the biggest thing that I would always come across is regret that they didn't give it their best shot, or they didn't pursue that goal, or they didn't, empty the tank, so to speak, on their goals. And so for me, my biggest thing is my biggest fear is being mediocre and not pursuing my fullest potential. I don't care what the results are. I don't care if I crash and burn and fail, but I want to know that I went for it. You know what I mean? And I overcame the fear and just gave it my best shot. And so I think if I was going to die but I knew I try, not even achieve everything you want to achieve, but try to achieve it, right? Give it your best shot and have no regrets and kind of empty the tank, so to speak. I think that's the biggest thing. And then along that journey, you're going to have achievements. You're going to be able to bring other people up and, create kind of this, energy of attracting people that are like-minded, and they're going to achieve success and have that same mindset. And that's cool when other people are, succeeding, and that you had an impact on kind of leading the way, or, bringing them along with you. And so I think those are the biggest things for me, is just, and that's why, I think it's very important that you don't get complacent. Even if you achieve your goal, you need to have a new, bigger goal, because, a lot of people that get depressed or they seem successful but are not happy is because they stopped striving for something greater, And as humans, I think that we all need to have this sense of progress, right? No matter what you've achieved, I don't care if you're a billionaire, you don't ever want to feel like you've just plateaued, right? We want to have a sense of progress, and that can be different from different people, and that's fine, but that's just how we're wired, right? And so I think, for me, I always want the bigger goal. I want to keep going and just know that I didn't stop, and that's kind of, what's important.
100%. I agree so much with you. Zach, where can people connect with Rise48? Where can they look up the kind of deal flow that you're having and what's coming up next in Dallas or Phoenix?
Yeah, thanks so much, Hannes. Yeah, so you guys can set up a call with me. If you go to our website, rise48equity.com, there's a link. You can set up a call, 30-minute phone call if you want to talk about our investments. You can just go check out our website. You can email me, Zach, Z-A-C-H, at Rise48, R-I-S-E 48equity.com, and look forward to chatting with anybody.
Awesome. We will also make sure to add this to the show notes. And thanks again for taking time out of your busy day to giving us some insights into how you build this successful company.
Yeah, of course. Yeah, thanks so much, Hannes. Thanks, everybody. Really appreciate it.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.